Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. And just after I've written an outrageous target column wherein I say that Abki Bar 50,000 on the Nifty, I think it's apt time to get somebody who could be vocally critical of that as well, because he doesn't spare any bones when he talks or any writes. Unmesh Sharma, I've been very impressed with some of the reports that he's written in the recent past. It's a pleasure to talk to him today. Unmesh, great having you. Thanks for taking the time out. And good to have you on Talking Point once again. Thanks for your time.
No, thank you. Let me correct one impression. I am actually reports not written by me. It's written by my research team. Very capable, very large. So yeah, but by our house. So I'd like to take some credit for it. So thank you for that.
So, but I mean, a collective effort. Let's put it that way. But Umesh, I want to start off with a point that you made in the email that we exchanged, which is that how is it that one? I mean, maybe I'm characterizing it wrongly, but it's also been a rally of disbelief of sorts in that not too many people participated, or even if people participated consistently through the last 1,000 odd points, there have been naysayers who've said the market is about to correct and it's only inched higher. What's happening here? What's the texture telling you?
Yeah, no, absolutely. I think I was probably one of them. Since I think about 18,500, we also have to, unless we can reflect and admit defeat, sometimes, you don't, you will never going to get it right the next time, right? So, do we hate it more now that it is 19,500, 19,300 on the NFT? Answer is, look, the underlying, what caught us by surprise? Let me answer that. Okay, why did the market not fall since 18,500, 18,600? I think one very, very large factor which we had not seen coming was the strength of the flows from the foreign investors. And I think on this one, we've been thinking very hard and discussing within our team as to what seems to have happened. And there are two very big factors. One is longer term. There are two signs which we have picked up in the last couple of months, which I think are very important. One is that geopolitically, incrementally, and I'm trying to link it to the politics as well. But if you see the way in which the foreign nations are lining up for India, I think at the margin there seems to be good long-term comfort that India is relatively more important. It was already in the MSCI emerging market basket, the second or third largest weight, but I think relatively importance is going up. So that's one. The second is that if you look at the near term, the big driver of flows into the Indian market has been the serious disappointment that has happened in China. In fact, if you look at the report written by our economists in Delhi, HDFC Bank economists in Delhi, what you'll notice is something that is now kind of getting confirmed. We had thought that there will be a very large resurgence in China now that the lockdown activity is over. And if you see, it's gone the other way. That has caught everyone in China and global investors and us by surprise. Now, if you have to allocate money to China in the emerging market basket, the way foreign investors invest is they look at MSCI emerging market, they put some weight. And China was a nice consensus overweight trade in the first quarter of last year. Let's say last quarter of last year, and I'm talking calendar year, and then early this year. And that seems to have reversed. So where will the money go, right? If we are the second or third largest weight, then a large part of that comes here. And I think that is something that has caught us by surprise. The Nifty tried very hard to break the all-time high for some time, 18,888, and then now that it's broken to, it has been quite decisive. So from that perspective, I think this is the reason why, to some extent, the naysayers have been wrong.
Unmesh, there is very rarely does it happen that the index touches all-time highs and the valuation comfort exists within the index, right? There could be handful of instances if that has happened, if at all. Usually, the all-time highs are accompanied by high valuations, and then over a period of time, we move higher. Now, how do you look at this market? Do you look at it as a market which is kind of consolidated for 18 months and then moved higher? Or do you look at the market which is very expensive relative to the other peers and therefore time for caution?
So, look, is it a market where you would go all in? Answer is no. Having said that, what will... okay, so see, I'm trying to preempt your question. The question is that will it come off a cliff? Will it stay here for a long time, or will it go up from here, right? So if that's what we're trying to... It's not coming off a cliff. Okay, I think that view we held even last time. So that's consistent. We believe that even if there is a correction, it will probably underperform some of the other markets, may underperform you, instead putting your money in fixed deposit or something like that. That is possible. But will it come off a cliff? Answer is no. Because I think longer term, one very big factor which you have to, which is also a correlation to what I was saying earlier, is that given the fact that China has not recovered, has also meant, one, money getting allocated to India. The second is that it has put, a lot of concerns on inflation down for the Indian specific market. Now, why specific to India is because, one, if you look at what's happened yesterday, right? Saudi Arabia has cut the production, and yet, oil prices haven't really rallied that much. They'll stay in the 70s. It's a nice sweet spot for India, honestly. Okay. The other is that if you look at what's happened to the other commodities, in fact, that's reflected in our model portfolio as well. We have no metals in there. What we are seeing is that all of that is helping India. So the external, if you look at the currency and the external vulnerability for India, it's actually, we are in a very strong position. So from that perspective, do I see money coming off a cliff if the market corrects another 1,000 points? Honestly, that's not really a correction. So let's say 4-5% correction happens, people pile back in, we believe. And from that perspective, I think we are okay. Now, the question is whether there is any trigger for a rally. We don't see it. Markets already, on any sector that we are looking at 2 standard deviation above, very tough at an index level to see how there is going to be triggers going forward. Also, at the margin, some of the larger sectors, if you look at, for example, energy, there is not so much happening. On the large banks, we are starting to see that some NIM pressure has started to come. So from that perspective, we will see steady returns on the steady earnings growth coming through. What, however, will happen is that now that we are in July, as we move into the next 3 months, result season, everyone busy doing all that. So once that is what has ended, what will happen is that expectations move forward to FY25. Because first half gets over, usually people start to either put their target prices on FY25 or as at least an average of 24 and 25. And FY25 is not well known, so the numbers there are in the teens as far as growth are concerned. So what will start to happen is that as that starts to get built in, there will be even more valuation comfort. So what is now looking 2 standard deviation above will start looking maybe 1.5 standard deviation above. And while it will still remain expensive, it won't be as expensive as now. So, we believe that it will go sideways for a bit. If I really have to bet, I would say it goes down a little bit from here, the market, but not seeing it coming off a cliff at all.
Got it. I love the way you say people are busy doing all that in earnings season, and then we quickly move to FY25. Pretty matter of fact, Unmesh. The Q1 updates, the Q1 updates thus far have not been too disappointing. So I've heard this constant refrain from some skeptics about how this 16-17% earnings expectation for FY24 will meet a rude shock. Thus far, in the commentary at the end of Q4 or in the delivery in Q1, it's not as bad.
Yeah, so look, so let me take you back a little bit in history here, because it had started with 19%. I remember distinctly, in fact, speaking even on this channel about the fact that the numbers before the start of the year were 19%. It's come to 15-16. We are at 12. Okay, so is 19 to 12 a rude shock? Answer is yes. But the way in which the market operates is not like that. The market has the slow bleed way of cutting numbers unless there is a shock. Now, there is no global shock happening, right? So there is nothing has come off a cliff. Nothing really has shocked us. There is no major movement. It's not like 20% oil moved or some currency collapsed. So nothing has happened. So what is happening is that before the first quarter itself, you got 3% cut, right? It's gone from 19 to 16. Will it go to 12? Answer is we have very high conviction. We are not going to get 16% growth. This is very high conviction. We will end the year at 12 or maybe even lower. But at 12, what that will mean is that 1% cut. Does anyone sell the market for a 1% earnings cut? Answer is no. So what will happen? People reconcile, move on, and then you see what happens. So, and then in any case, by the time we are at December, people will say, okay, 24 to ho gaya, 24 is done, right? So let's move to 25. So again, that number will not matter. So from that perspective, what is happening is that we are getting a very slow bleed on earnings numbers, like with the exception of the COVID year and 2008 crisis. I think we have never had this type of year. It's always like that. You cut 1 or 2% cut through the year, and that's your 4 to 5% kind of cut for the year. That's what will happen this year as well.
Okay. Well, I'm hoping it doesn't. But since you said it's a very high conviction, but I'll go ahead with your numbers. You will do them much better than I would. Let me try and figure out how do you play, therefore, a scenario wherein you don't see the possibility of any kind of material upsides at the current valuations in any of the sectors. Because like I heard you say, most of them are 2 standard deviation above what you normally would pay, right? And keeping in mind the fact that some of the heavy duty ones, I heard you say NIM compression in banks, but NBFCs, and thus far that I've seen them from Bajaj Finance, MM Finance to whatever, the numbers are looking solid. So how do you play BFSI?
Yeah, so look, large banks continue to remain consensus trade. They remain kind of neutralish to slightly positive on our portfolio as well. We don't see any reason to change that. Okay, because you will get the earnings growth, as in all the book value growth, whatever, however you want to see it. So that's not an issue. As far as NBFCs are concerned, we believe, in fact, interestingly, I was having this discussion this morning with the team because I was wondering as to, whether this is something which will lead to, this aggressive growth will lead to any issues on the corporate asset cycle. The honest answer is that at this moment in time, there is no leading indicator that the asset cycle is looking bad. Now, will anyone sell the market in that kind of scenario? Answer is no. We need to see at least some early shoots as to whether there is a problem on the asset cycle, and we are not seeing that. Okay, so as of right now, we stay invested. Now, as far as the differentiation within the NBFC is concerned, with the so I work for HDFC Securities, so I can't comment on the merger. But at the same point in time, one implication is that HDFC Limited kind of vacating space has led to a surplus of liquidity which could be made available to other NBFCs on the lending side or the bond market side. So that actually helps the AAA, AA corporates. Now, so amongst the NBFCs, we believe that for the next 3 years, there is a nice runway on the funding side for the AAA, AA corporates. And that's how we are playing it. If you look at our model portfolio, that's kind of structured accordingly as well. So we like the large banks and we like the larger, more critical, higher quality NBFCs. That's how we play it.
Got it. The other aspect is, and last question really, what else do you do? We've spoken about large sectors. I take it on board that IT is a bit of a black box or definitely not the most overweight space. You've given us a view on banks. That's about 40-45% of the index. What about the rest? Where is it that you're finding favor? Where is it that you're extremely cautious?
So I will break it up into 3 parts. The first is that whenever you are in an expensive market, one is that, look, I've been trained, and honestly, 20 years of experience shows me that you should never stay in too much cash. We don't, in a model portfolio of 2%. Okay, we'll stay there. So where do you invest, right? The 2 big themes we can see playing out now is stay as much domestic as possible because India is doing great and relative to the rest. The second is that commodity consumers in this environment, because I just talked about what happens in China and globally, and genuinely, there is the only risk that you run through the rest of the year is that there is a slowdown in global growth, even though there are no signs of that yet. But you would have seen that in Australia, in Europe a little bit, where recession concerns have come, as in slowdown concerns have come. It could spread to the US. Now, so demand could be where you get negative surprise. But at the flip side of that is that on the commodity consumer side, you could see positive surprise. So we'd rather play margin than demand. Okay, so domestic, play companies which will get demand uplift in the scenario that I'm right, and don't play so much on global demand. So in that context, IT is not an overweight. We are very selective on companies which are, specifically targeting niches which we like. So relatively, we now like the mid caps a little bit more than the large caps. Among the large caps, valuations have come off a little bit, so that's good. But we are not very, very positive on the IT space. We are neutral. What we are doing is looking at longer term thematics. We are turning a bit more positive on the consumers, especially the staples, because of the commodity angle. Cement we like as the same result. OMC is within the energy basket we like. And then we like the longer term thematics like gas and financial inclusion like insurance and capital markets. So that's how we are playing this.
Well, maybe the next conversation that we do, I'll peel off some of the layers of this conversation, Unmesh. By then, maybe we'll be closer to the beginning or the onset of the festive season. So we'd love to understand a lot more about consumers in that conversation. But thank you for taking the time out today and speaking to us. Much appreciated.
Thanks, Neeraj. Thank you so much.
Rizar's viewers, thanks for